Okay, hello everyone. Welcome to another show. We missed you all yesterday, but we're back again. If you can hear me very well, sound quality is good, give me a thumbs up so I know it's good. As I'm starting, I was actually reading the FOMC meeting. I was reading the notes just to get an idea of what's happening and what was discussed and what we can expect. We're gonna discuss that. Andrew's in the room. How you doing, man?
I'm good. Thank you so much, guys. Hello. You guys hear us? Give us a thumbs up if you can hear us.
Yeah, they can hear us, yeah.
I was taking a nap at the office. It was pretty good. So let's see what the market is doing. Reaping higher, that's what we want.
So, Andrew, what was going on yesterday? How come we didn't have a show?
Well, Ali, you are the driving force of this show, really. And without you, it's really hard to go live. Brian mentioned that he can come, but I still think without you, this is really, really hard to.
This conversation was not rehearsed, by the way. I had no idea he's gonna say that. But anyway, we missed everyone. I was in Denver for the 4th of July long weekend. I had a great time. Didn't check work email, nothing for a few days, so it was really amazing. Feeling really good, and of course coming back to market. Tons of stuff to talk about. So I want to talk about the yields getting inverted, what that means, what kind of the market is pricing in. I'm going to talk about another relative trade that I think would do probably really good in the in the next half of the year. We're going to talk about Tesla deliveries, the FOMC meetings, Andrew's trades, tons of stuff, and then I'm going to introduce tomorrow's guest. We have a really special guest again tomorrow. We have a series of really amazing guests coming in, so really excited for that as well. Andrew, how was your day today? What did you trade?
I traded TQQ and Rivian this morning. Rivian was, sorry, I just had some orange in there.
Oh man, I shouldn't have asked you to come.
So I had a good trade on the Rivian. Unfortunately, I didn't get the best move that I wanted for the break of 30, but Rivian, if you go to my chart, Rivian had a really nice opening range, 1 minute opening range break up. Did a consolidation. I loaded up here at 2860, and we get this move up here, and I posted my recap as well. I also posted on Twitter, there was a huge ask at 30. That was a sign for the breakout for those of you who are trading based on the level 2. So that was a good trade on that front.
Andrew, in your trading, you don't use level 2 as much, right? You mostly look at time and sales.
It's mostly time and sales for me, but sometimes for the breakouts, I'm looking for the level 2 to get the confirmation. And if I can get a good confirmation, I might actually load up and increase my share size on that.
I see. Yeah, very nice. So Rivian had a positive catalyst. I think their delivery was more than the expectation. On the other hand, Tesla missed on their deliveries. We're going to talk about it later in the show as well. So we had the FOMC meeting coming out, the minutes coming out at 2 o'clock. And right when the minutes came out, we had a little bit of indecision for majority of indices. And then we rallied higher, and we're still pretty strong. I don't know if anyone is in that trade, except for IWM, which is still weaker. Which, by the way, was that part of that relative trade that I've been shorting IWM. Still short plenty. But even Bitcoin rallied. So, Andrew, did you have a chance to take a look at the FOMC minutes? Or
no, I did not, unfortunately. But I know you were reading it, Ardip.
Yeah, I was in the midst of reading it. I was kind of halfway through. Again, these minutes are from what was discussed in their last meeting, so it kind of gives you. It's a little backward looking, but it kind of give you an idea of what they're thinking and what they're going to do. And the only key takeaway so far that I've been reading was, number one is they're paying close attention to the equity market. So it's one of the things that was discussed in the minutes. And the number two was they're going to continue on kind of being aggressive on the kind of the 50 basis points, because they really want to bring the inflation down, and they don't want this high inflation to kind of get embedded into the new economy, or after COVID economy, as you may kind of call it. But definitely expected that rally on NASDAQ. So Andrew, you took a position on TQQQ, right? So and we talked about this, why I believe over the next 6 months Nasdaq 100 is going to outperform S&P 500. Now, it doesn't mean that it's going to close green or it's going to do so much better. All it means is I believe if SPY drops another 15%, maybe Nasdaq drops only 7 to 8%, just because of what's happening in the yield curve and anticipation of further cuts maybe in 2024 or late in 2023. We'll talk about this as well.
Yeah, definitely market has been really, really choppy. Looking at TQQ, SPY, look, just this absolute choppiness at the market. It was really, really hard to get any good breakout at the open. After the Fed's meeting came out, there was we saw a big volatility, and eventually market finds its direction to the up. I got my TQQ, I loaded up around 25.50, around that area. I think I started early morning. I got some shares going on and see if we can, for the next couple of months, we can ride it a little bit higher.
Yeah, that's amazing. Let me see if I can bring on the yield curves. Till we find it. We got about 100 people joining our show. Thank you so much for tuning in. Really, really appreciate it. Give us a thumbs up. Give us a like if you like the show.
Yeah, thanks guys. I appreciate that. Your thumbs up really helps and supports our show. I mean, these algos work based on how engaged the users are and how engaged in the chat room. So I really appreciate it. Ask your questions if there's anything that we can help or we can answer in the chat. I'm monitoring the chat myself as well. The market is still strong. Qs are up 1%, although there are some pullbacks happening right now. SPY is up 0.6%, and IWM is still lacking, unfortunately. Even after Fed's meeting, they popped up, but they really couldn't go in green.
So, Andrew, I want to spend a little bit of time on the yield curve today because I think there's a little bit of learning, but also a little bit of trade idea for those of the traders who are kind of position traders, are looking for a 6 months, 3 months, 4 months positions to take at a time, and at the same time being hedged. So when you look at the yield curve, right, and we've talked about this yield curve a lot, and we say, hey, the normal yield curve should look something like this, like what we saw in 2021, so right last year. This is kind of a normal looking yield curve. The higher you go in duration, so 30 years, 20 years, the higher the return you're gonna get is. So that's kind of your normal looking, proper looking yield curve. This year, because the Fed was so aggressive and was raising rates, the front end went a lot higher. So if you compare this line, which was last year, the 1 year rate was almost at 0. Now all of a sudden the 1 month rate is at 1.25. So the front, it's called the front loading. So the front side of the curve is going a lot higher because the yields are going up, right? That's what the Fed's fund rate is doing. But because we're seeing so much a slowdown in the economy, so what do we mean by a slowdown? We look at ISM data, we look at HMI data, the housing data, we look at new orders, right? Because we're seeing so much a slowdown, now all of a sudden this further part of the yield, which is the 10-year, is going down. And we're in a situation where the 10-year now is lower than 2-year. This is signaling, so let me clean this a little bit here so people can see better. This is signaling that the Fed has to cut in the near future. So look at 10-year, it's at 2.92, and look at 2-year, it's at 2.96. So 2 is higher than 10. Now what this means is that the market is anticipating a rate hike, because all that 10-year is what the Fed's fund rate is going to be 10 years from now, right? That's all it is. So market is anticipating that in 10 years the rates will be lower than in 2 years. So there will be a rate cut. And which sector is the most strongest when there is a rate cut?
The technology sector, the duration, because all of their cash flow is projected in the future because they are growth companies. And if the interest rate goes up, the value of those future earnings are going to be lower. That's why they got really hit really bad. And if the rates are going to decrease, then the value of those ones go back up because they're it's all about the duration, the future cash flow.
Yeah, exactly. So if you're kind of a position trader, I think if you were with us last week and you took that bond trade with us and you made money, congratulations, that's amazing. If you want another trade idea for this next 6 months, I think a relative trade where you go long Qs maybe 2 times long Qs, and short SPY, I think it's a really good relative trade where you can probably get 5 to 6% out of that relative performance. I think the Nasdaq over the next half of the year will outperform S&P 500 or even IWM, especially IWM. So that's another way you could play it, and then you go long the Nasdaq and short the SPY, and that kind of acts as a hedge to one another. If just based on what's happening in the bond market and looking at yield. Of course, not a financial advice, and monitor your own risk to reward and things in that nature.
Yeah, so Tesla couldn't really run really well. Rivian is still up 10% because of the delivery that they had.
What is Tesla doing?
Tesla is actually flat, pretty much 0.5% down. Is hovering around $700, which is the previous day close. It didn't have the momentum to continue going higher.
So I set up a trade on Tesla today. I did a condor on Tesla, so let me bring this up. This might be interesting as well before we get into kind of the. So as you can see, Andrew, a pretty clear range here is in Tesla. So this would be kind of the lower end, and this would be the higher end. And I'm kind of betting that Tesla will be around this range until Friday, which is the expiry. So this strategy is called condors. For those of you who are option traders, and when the market is choppy and is in a range, it's really hard for day traders sometimes, but there's a lot of opportunities for option traders. So you sell some premium on the top part, you sell some premium on the bottom part, and you kind of bet that the stock will be around here. You could do condors, you could do butterflies. There's a lot of strategies where you're solely betting on a range and a collapse of implied volatility, and you get to keep a lot of the premium. So let me just monitor the chat and see what's going on. New to trading, just read your book, really enjoyed it. So why is asking you a really interesting question, Andrew. Is this the right market to get into trading?
I think so. Yeah, I think the markets. The last few days was a little bit choppy, but overall, what traders want is volatility.
Yeah.
And the volatility is really good. Either go to the down or go to the up. This is a good market to trade. Today, for example, was a little bit choppy, but overall it's really, really good. Risk management is very important, and in any market condition you have to learn risk management, and it's actually not a bad idea to start learning risk management in a volatile market, especially new traders start on a simulator and go step by step. I think it's very, very good, very important for them to learn risk management in a volatile market. I think that's a really good. If you start trading in a bull market that is not really that volatile, everything goes up by just buy goes up, you might get into the habit of not managing your risk, and that's usually a very, very difficult, a very, very bad thing that can happen to you.
Yeah, just to kind of add on to that, I think why you got really lucky in a sense where you kind of missed the 2020-2021 run, because you would have made a lot of easy money and you would have thought that, hey, this is the market, but you missed that part. I personally know a lot of traders who changed their Instagram bio to full-time traders, and then they lost everything, right? Because they were in that rally of everything bubble and they made so much money and they thought, oh, this game is easy, without learning the proper risk management. What does R mean? What is risk to reward, things in that nature. So I think it's a great time to start personally. And also, I think if you're a trader and you survived the 2020, 2021, 2022, if you've survived this 3 year and you've been able to make money and stay in the game, kudos to you, because this is where a generation of traders get lost in the market, right? We lose generation of traders because the losses are so bad. Look at the names, right? Like even the blue chip names in this market, like Tesla, from 1,200 to now 600, like cut in half. Look at Apple. Look at look at energy, right? Everyone was saying, hey, energy is such a great trade. Now it's down almost 30%, 35%.
Yeah,
that's insane.
That's when something you hear is, you might be really late, and you might say, oh, the Russia attacks and the whole world. Yes, you are right, but the market is always really early. They're really, really smart. By the time that it hits the Main Street people, you might actually lost the move.
Yeah, one of the best thing that was said was someone saying everyone's gonna lose money in commodity this year because of how choppy it is and how crazy it was said in Twitter, and I think it's really true. Let's get started. We got a lot to talk about. If there is no more questions about the market, let's go.
Rebecca is asking a question that any advice for trading a choppy market versus a volatile one, and how to tell which one we. So Rebecca, that's a very good question. Sometimes you don't know you're in a choppy market until you at least get chopped up once or twice, and then you realize. Usually the choppy market has very low relative volume. Volatile markets, it has a lot of volume. Gapping up or gapping down significantly also can tell you a volatile market. But today, for example, the market was pretty much opening flat. And you could expect that, okay, there's not a lot of volume, there's no news, and you're opening flat, not gapping up 2%, not gapping down 3%, then therefore you can expect a choppy market. So it comes with experience as well, but also relative volumes. A lot of trading platforms, the scanners are giving you the relative volumes, and the relative volume is usually good enough to know if you're in a choppy market.
Yeah, I mean, just to add on to that question, Rebecca, it depends on are you defining chop in an intraday or in like your swing trading and stuff like that. That's also another thing, because intraday the market could be choppy, like the market we're in right now. Intraday is very choppy, but when you look at the chart, like look at my screen, the trend is pretty clear, right? It's a downward trend. You can see it very clearly. So it all depends on your time frame and what time frame you're looking at as well. So. Bearable traders, if you're a member with us, we cover a lot of day trading, option trading, swing trading. So we cover you on all those aspects. So, a lot of opportunity for you to take advantage, even if the intraday is choppy or even if the daily is choppy. There's always opportunities where you can take advantage of. Apparently, the market is selling off again. This is what the people in the chat are saying. So
there are some sell-off. I can see that it's not a crazy sell-off, but again, we are getting into the final 5 minutes of the market. There might be some repositioning in that. There are definitely some sell-off.
Yeah.
IWM is down 1%, is the weakest. Plus the VWAP, Qs are also selling off in the last 5 minutes. So, I mean, not as significant. I think that today would be a day that both of the indexes like SPY and Q close pretty much flat. We'll see. We have been in a very, very clear downtrend starting April 1st. And then later before starting 2000. We had a big rally in the early March. We had a very, very reaction rally in the early March, but beside that, we've always been in a downtrend, lower highs, a very powerful drop that we're seeing right now. Let's see if market turns back or continues this downtrend. Nobody really
the market psychology is really interesting, Andrew. People talk about like how sentiment is following the price action, not the other way around. I remember when we had that rally in March, people were saying, "Oh, all-time high in a couple of months," and it's so insane where sentiment was so positive then, but now it's so negative. And one of the things I think a good trader should really understand is that the sentiment follows the price action, not the other way around.
100%. That's very true. They say the days that you're gapping down and then you rally up and close green, they say at the beginning it's just a financial meltdown, and then on the rally everyone says, "Oh, that's a great economic recovery and soft landing." So it's a very important thing because our mood is also changing. My mood is changing with the market.
Yeah.
If you are long and you have a big position and market rallies, your mood is really good. Your sentiment is changing. You see the life even better.
Yeah, you feel a lot richer. Yeah, definitely. Yeah. Okay. So let's get into recession talk. Let's get into the slide deck. We got tons of slides today that I want to talk about, and then for tomorrow, I've also made the slides for tomorrow. Really interesting stuff for tomorrow, and don't miss out. Before I actually start, shall we talk about our guest tomorrow, Andrew? The guest that is coming on the show.
100%, yes, 100%.
So the guest who's coming is Jay Sink. He's still we still about 90% sure he's gonna make it to the show. We're just finalizing, but he was ex-Goldman trader, so he used to trade at Goldman Sachs at their merger arbitrage desk before 2008. So when the investment banks could take proprietary positions, and after the Volcker rule and after 2008, the banks couldn't really trade their money because of the regulation. But ex-Goldman traders managed over $2 billion. Really amazing stuff on Twitter. He puts that called Special Situation Newsletter. He has a newsletter solely focused on SPAC arbitrage. He was nice enough to agree to come on the show. I think it's going to be an amazing show. Real institutional trader, talk about his experience. If there's any specific questions, feel free to email me beforehand. He'll be on tomorrow at the 4 o'clock at the close. So it's going to be an amazing session, an amazing guest. And then next week we have the one and only Brian Shannon, right? So Mr. Shannon is coming on the show as well. He agreed. And then I think the week after we have Jared Dillon, another ex-Lehman Brothers trader. So we're bringing a lot of value and a lot of guests. And part of it is because you guys make this show so amazing. You guys tune in and watch the show and give us that like. That brings the show a lot more credibility, and we can bring on more and more guests for you.
Yeah, excellent.
All right, so let's get into the recession talk. So Andrew, Morgan Stanley has a model, and this is very interesting. So in their model, this regression model. So it's based on the consumer survey, gap between the 10-year and 3 months, so the short end, and long term, and then the treasury yield. So it looks at these factors, and currently their model is pricing in at about a 40% recession next year.
Yeah.
Okay. And tomorrow I'm going to spend some time talking about how we haven't really seen a recession bear market. All this sell-off that we've seen, I have a slide ready that I'll show you tomorrow, is mostly because of the rates, and the rates going up, so the market coming down a little bit. So things could get really ugly if there is actually a recession happening, and let's say earnings drop by another 15 to 20%, especially if you have a longer term portfolio. Andrew?
Yeah, so definitely that's very interesting. I mean, I think that Dr. Michael Berry also said the same thing, that all of this drop that you're seeing is just because of the interest rate hike. And if the companies, which the earnings season starts pretty much from next week, start hitting missing their earnings, then you're going to actually see the recession correction. That market can actually have another 10-15% drop in it as well. So what you're seeing here is that the toughest and the most aggressive rate hike that Federal Reserve has done since 80s and 90s, plus the fear of recession from the earnings of the companies. So the corporate margins are definitely shrinking. I personally can see that in my businesses as a small businesses, that the profit margin is going to significantly shrink, and we're going to have a very, very interesting time ahead, especially in the next earnings season.
Yeah, I think the next, as business owners, the next 12-16 months is going to be very telling, and the businesses that are really strong and agile are the ones that survive. Speaking of profit margins, interesting, Andrew, you mentioned that, because take a look at this chart here that shows the corporate profit margins, and kind of the trend again is very clear. Probably it's going to be even lower for as the Q2 earning comes down. So when you have margin compression, it's called margin compression, margins coming down, that means valuation comes down, that means lower earnings, lower earnings means lower valuation means lower prices. So that's how kind of all of these link together, and that's how it explains some of the sell-off that we're seeing in the market. But today was a good day, at least. And another really interesting fact that I saw over the weekend, and I thought I'll share, it's this concept of deglobalization, Andrew. And you've talked about it a lot, and it's one of the key factors that is leading into the inflation we're seeing. So this is the number of time the management in their earning calls have talked about onshoring, reshoring, or nearshoring. When you compare it with early 2020 versus now, the Q1 of 2022, you can see a lot more of onshoring, a lot more of reshoring and nearshoring. So people are talking more and more about bringing their supply chain really close by. So if you're an American company, rather than having it in China, you want to bring it like nearshoring, aka maybe Mexico, or maybe Canada even, right? Or onshoring, like we know about what's that chip manufacturing company called that is not doing very good?
Taiwan Semiconductor?
No, it's the American one, Intel. Yeah, so we know about Intel, like the $1 billion they're getting from the government as help and bringing kind of their chip manufacturing onshore inside US, right? So you're seeing, this was a really interesting stat, that more and more CEOs are talking about these three keywords: onshoring, reshoring, and nearshoring, which, by the way, will act as another inflationary pressure on the market.
Yeah, 100%. I mean, it started in the early 90s after the Soviet Union collapsed, that to stop another Cold War and another conflict, they decided to bring the world together. Globalization started from that time when they bring China on board. I think President Clinton was one of the leaders that they're trying to bring China into the global economy and tie their economy into the global economy, so they're not going to become a problem for the rest of the world. And that would work really, really well. I mean, what we saw, the amazing growth that we had in the last 20 years, and very low inflation. One of the reasons that we saw such a small inflation in the Western countries was because you had access to, a huge supply, and you can just get anything at the lower price without any problem of supply. But the 2020 pandemic showed that a little bit of glitch in the supply, in the globalization, then can cause 8, 9, 10% inflation.
Yeah.
And that scared a lot of people, that's especially the companies, and now they have to be more resilient toward the supply chain issues.
Yeah.
Who knows that what's going to happen with the Communist Party next year, and then they stop making some changes and regulations, and then they have to be resilient for that. That's why talking about onshoring and bringing back the production here.
I think there was a news, I don't know how the stock reacted. Maybe, Andrew, you can pull it up, ASML, that's the chip manufacturing stock. I think there was a news that US is putting a lot of pressure for them not to sell the machinery to China. So ASML makes the machinery that makes the chips. So they're kind of the first degree of the chip manufacturing. They make the machinery that is needed for the NVIDIA chips and all that stuff. So I think there was a lot of political pressure for them to stop selling. It's a Dutch company, to stop selling their product to China. So very interesting. And again,
but in reality, it's a very, very complex thing. The supply chain, bring the jobs back. I mean, that was the whole political slogan for the previous administration when the President Trump says, bring the job back home. I mean, it's not as easy that we can think. The world has been so interconnected that it's not something that you can do overnight, and there is a lot of independent companies. I mean, politicians can do to some extent, but as you mentioned, there's a lot of geopolitical issues in that, and sometimes you have no control over all of this. I have to put the political pressure for the companies to move.
Yeah, and a decade of low inflation we've experienced was partly because of this globalization, right? Before, without getting really political and kind of sticking into the market, this is kind of the same tone that we're seeing from, a European Central Bank president as well as the Fed Jerome Powell. So the ECB says, I don't think we're going to go back to that environment of low inflation. Kind of talking about that 2% or disinflation even in Europe that we experienced over the last decade, but I don't think we're going back. Same thing, Jerome Powell was saying exactly the same thing. The heights of disinflationary forces are gone. We must think about monetary policy in a very different way now. So these are, again, really hawkish statements of, hey, forget about that 2% inflation. That's probably gone. But let's see, right?
So essentially saying good times are over, get ready. I mean, you have to look into that as well. I mean, I grew up in Iran, and in Iran, when I was growing up, in a good time, we had inflation of about 8 to 10%, and the economy grew. And 8% is not a crazy number if you have the economic expansion and wage increases to support that. But the problem is that a lot of people on the lower income and the lower middle class are not catching up with the cost and the wage increase, and that's why it's a little bit scary for the lower, class of economies.
Yeah, definitely. But then again, the risk-free rate in Iran was 20%. Right? The banks were offering a lot higher risk-free
That's why they have
rates,
to increase the interest rate to match that situation. And as long as the inflation and the funds interest rates is going to come closer to each other, they close that gap, it would be a better economical situation.
Yeah, people who are watching the show might not believe a risk-free rate of 20%, but this was a reality, you know, in the Middle East, in a lot of the developing countries where you can get 25-30% just out of your checking account, which is
but they're nominated to
crazy.
their own currency, so you have a currency evaluation in that environment as well. So, I mean, the risk-free on the US dollar, which is a more stable currency, it would have been significantly lower in that.
Yeah, exactly.
But regardless, I think it's very important to see that there are some news that are coming that port activity in China is normalizing really fast.
Yeah.
So it means that there's a lot of these glitches that we saw in the supply chain might resolve really soon. I think China is completely open now, which is very nice. So we could see some of these supply chain glitches are going to go, like the chips for auto manufacturers and stuff. So it's interesting to see what the summer is going to bring for us.
Yeah, let's talk about, speaking of auto manufacturers, let's talk about Tesla. The delivery numbers were out, so if you can see my screen, first quarter in 3 years, that the delivery numbers actually didn't increase and actually decreased. Of course, Tesla is going to blame the supply chain issues and the opening of the Berlin Gigafactory and not being up to par and things of that nature, but you can't really forego the competition. I think the competition is really catching up. So, you know, one of the companies is backed by Warren Buffett, the BYD. They're doing really good. They delivered over 641,000 cars, electric cars in the last quarter. Same with Kia. We were talking about this over the weekend, right? Kia, Hyundai, these are making really amazing electric cars, and competition is really catching up to Tesla. And it's going to be really interesting to see if Tesla and this narrative of more than a car company, the tech company, the data company, all that stuff, if it can hold up, if the numbers are going to continue to be like this.
So yeah, I mean, I don't know. You mentioned about BYD. Are they selling luxury cars? Because Tesla is considers a higher price luxury. I don't know what the price range of BYD is. That.
Yeah, no, I think BYD is their car is a little lower, I believe, in terms of price range, and that's one of the things that. Do you know who Jim Chanos is, Andrew?
No, I don't.
So Jim Chanos is one of the most well-known short sellers, right, in the world, and he was one of the guys who, figured out the Enron scandal, right? These special entities that Enron was kind of developing and moving some of its liability off balance sheet. Really smart guy. He's been in the industry for over like 30 years, and he was talking about Tesla and this fact that they're mostly selling luxury cars, and when you look at the models that estimate how many cars they can sell, it kind of says they're probably going to sell 10 million cars by 2030. But in US, only 2 million cars each year are sold who are above the 50,000 mark. So the luxury market is really small in the US. So some of these models, they might make sense mathematically, but when you look at the real world, unless Tesla can make really amazing electric car for really cheaply, it's impossible to obtain. And this is one of the questions I want to ask our guest tomorrow as well, since he's been kind of in that arena of valuing companies, of what he thinks.
And also, I mean, do we have enough supply chain for lithium batteries to supply that? There's a lot of these models that they might miss that. That's why I can start a model and publish my model. But if you get to that huge number of the EV production, do you have enough lithium? And if you do, the supply chain and manufacturing of the lithium batteries can support that kind of production as well.
I'm not really familiar with those models.
Not with this type of model, yeah.
But no, all jokes aside, yeah, exactly right. Because it's just a line item on Excel, right? You can just put anything you want in it and then just exploit it, throughout your thing and come up with a price target. But is it really, like I was reading, electric cars need 5 times more copper than regular cars because of the battery and the electricity inside them. And copper is the only elements that we know that can be, what's that word called, induce the electricity, right? Yeah. So you have a lot of supply chain issues that are not being counted into these models.
Or there are a certain type of nickel that is only sourced from, I think, one mine in Siberia in Russia, and the sanctions can impact that as well. So there is a lot of different elements going into that direction. Yeah, so interesting to see. In terms of price action though, if you're a trader,
forget about fundamentals. Price action, it seems like Tesla is trading in a range, so a really good time for condors, for butterflies, and then of course intraday. Such a great stock to trade, right? Right, Andrew?
Yeah, that's 100%. I mean, just a quick advertisement for those of you who are part of the member. If you show my screen, that we have, as you know, we are in the bear market. Some indexes like QQQ and IWM are deep into the bear market.
Yeah.
Dr. Kenneth Reed, he's a trader. That this is the fourth bear market that he's trading at. He's gonna have a presentation about the 10 things that you need to know to trade in a bear market. So for those of you who are interested, don't miss this presentation. It's at 8 p.m. Eastern time for all the elite members. And if you're not a member, you can always upgrade. And we're really interested to hear that. I love Dr. Kenneth Reed. He's an amazing speaker. He's a trader, and he's such a great personality. So looking forward to that as well, guys.
Yeah, definitely. Last couple other things I wanted to talk about before we call it a show. By the way, we have over 200 people joining us. Thank you so much for tuning in after the close. Hopefully you had a great trading day. Is the ISM numbers that came out on the service side. So the manufacturing numbers came out first day of July, and of course they were pretty bad. But same story with the service, a little better, but still on the way down. So as you can see, these are again leading economic indicators. So what happens in these guys will kind of forecast what will happen with employment, what would happen with the equity market. So on the way down, estimate was 54. It came a little higher than estimate, so at 55, which is pretty good. And a couple of keynotes from the ISM numbers that I took that I want to talk about is. This was kind of interesting as well. Again, consumers are shifting purchase away from our discretionary product to essentials. Inflation is definitely taking a bite from our sales. Mall traffic is far below the norm, potentially due to inflation and need for more disposable income on essentials and less willing to drive to the mall. So this was from a manager at a retail location at a mall, right? When they do these surveys, this was kind of what he's seeing in the business market.
Did you notice that Adi, the Instagram, the messages were not working, DMs for a lot of places. I had 24 hours of not getting any messages in my Instagram.
I did send you a DM. I was surprised you didn't reply.
Yeah, I didn't. It didn't deliver actually.
Oh, wow.
So I had to update my app again. To get rid of that. So
time to short Meta?
No, I don't know. Meta is not really doing well at all, actually.
This is how we do our due diligence, by the way. It's just like...
Well, Meta doesn't really need a lot of due diligence. Mark Zuckerberg has done a big gamble on Metaverse. He already has been very, very explicit about the cost cutting. Mm-hmm. And he actually said something that really, I couldn't believe seeing that. He said that, there's a lot of people that probably shouldn't be here. And when the CEO comes and says such a thing, I mean, it's really not a good
shouldn't be here in terms of like the cost, or that they don't want to be here, like they shouldn't be here.
No, they said that definitely there are some rooms to cut the staff, and when the company like Meta is talking about reduce hiring freeze or potentially laying off people, that definitely not. Something is not really going great in there.
Yeah, well, there is one thing that could act as a great tailwind for Meta, meaning a great catalyst to the upside, is if US decides to ban TikTok. And there's a lot of saying of banning TikTok. We know Mark Zuckerberg went huge on Reels, and Reels is supposed to be the competition to TikTok, but still I think it's an inferior product. But if they ban TikTok, being a Chinese company, that could act as a huge catalyst. So
I think, to be honest with you, I don't know. I mean, I'm not against the open market, but when the Chinese companies are banning everything, they're reverse engineering all the technologies, then why would you open all of your users and data and their attention, essentially, of all of the Western countries to a Chinese company? That is not, the reporting is not even accurate. I don't know if the number of the views that the TikTok is really reporting, or the number of the followers are actually real or not. I mean, you have no control over that. And one of the reasons when they pump up with the likes and views is it encourages people to create more content. And that's why Twitter actually started verification process again, because they noticed that when people are getting that verified, they get more engagement, they create better content.
Yeah.
And I think I'm of the person that maybe in the future, maybe we never know in the future, the TikTok, I think they're pumping up the numbers in terms of views. What you see is maybe 10 times or 5 times or 20 times higher. And when you see your video has been viral and you have 100,000 likes, then you create more and then you create more and then you create more.
It's definitely possible. I mean, 100%. But if you've been on TikTok over the last few months, you can see a lot of American companies are spending good money on advertising. So tons of ads are coming up, and it's US, Protocol and Gamble and companies in that nature, they're running ads on TikTok. So this is a lot of revenue that could be inside America going into another
exactly.
country. Right?
I mean, exactly. That's what I'm point. And you're dealing with a country that they are explicitly banning all of the American or Western technologies. Like you don't have WhatsApp, you don't have Gmail, they're all filtered. You don't have Meta. There's all of social media, and majority of the technologies are banned, and they have their domestic version, like a WeChat, which is essentially their social media app. So it's a very difficult question to ask, especially for the global. It goes into the globalization and politics involved. But we'll see that. I know President Trump was not a big fan of having TikTok so much access to the Western countries.
Yeah, just the eye test though. Again, eye test doesn't mean anything, but like from the people who are around me, I can see a lot of people are spending more time on TikTok and less time on Instagram. So I don't know how much, like the eye test would tell me people are spending more time on TikTok, but is it really millions of views? Who knows, right? They might be cooking those numbers up.
And they're shorter as well, so that's another thing. I mean, you probably can browse much faster in TikTok and the number of
watching our show on YouTube. Yeah, exactly. Last thing is commodities. I mean, look at oil, look at natural gas, soybean, wheat, corn, copper, cotton, all of them down on so far in Q2, which is really, really interesting. Commodities have had a really difficult time. So commodity first half of the year was an amazing trade, right? With the talks of inflation and high inflation. And all of a sudden a flip, like a switch flipped from the inflation to recession. You can take a look at XLE, which is the energy conglomerate. You can look at the forward rate for oil or copper or any commodity for that matter, and all of them are down tremendously. And that's one of the things that make this market really challenging, is you can't close your eyes and pick something. It's you can't really, you have to have a plan. If you don't have a plan and you want to kind of chase trades, you're gonna end up losing money. I mean, think about people who got into energy a couple of weeks ago, right? A month ago, they're down 30%. On the best performing asset of the year, you're down 30%. Like, think about how hard of a market it is. All right, 181. Let's go. Couple of interesting things happened on Twitter. Let's view that and then close the show. Thanks everyone for tuning in, and if you haven't already, please give us a thumbs up, like the show. Tomorrow we have a guest who used to be a trader at Goldman Sachs, so definitely tune into tomorrow's show as well. It's going to be an amazing show. But a couple of things happened in Twitter I want to discuss. Friend of the show, Michael Gayet, was really busy on Twitter last week, and he was talking about how the sell-off that we saw this year was kind of a black swan event, right? Black swan events, for those of you who don't know, kind of being, black swans are usually white. They don't happen as often, and they're very rare. And he was basically talking the drop that we saw in the treasuries as well as in the S&P 500 has never happened before. And he is right. When you look at all these scenarios, treasuries have always acted, every time that the S&P has dropped, treasuries has acted as a safe haven. So you can see it here. The purple line is the treasury. You can see it in this drawdown. You can see it in this drawdown. Again, treasury went up. This is the only time that this magnitude of, let me zoom in a little bit so people can see it better.
Adi, I think in 1973-74 is the same thing, if you look into that, isn't it?
Let's go ahead and zoom in a little bit. Give me one sec. 1973, 1974, yeah, but not in that right here, right? Let me see.
If you can mark it over there.
Right,
no, yeah,
here, yeah, but again, not
1968 as well, yeah.
Not in that magnitude. So you're looking at double digit 20% on both equities and bonds. Like here, the 60-40 portfolio would have really helped your drawdown, right? You would have been down 15%. Here in this scenario, you would have been down 20%,
I see.
more than 25%. So almost double, right? So it looks like they're very close in the chart, but you know, every percentage point when you're managing your own money is a lot of money. Like if you have $1 million account, each percentage really matters, right? So that's another thing. Bill is saying, what do you think, Artie, when it comes to oil, gasoline, crude, there are still structural issues in the economy? So Bill, I bought some XLE. I think the sell-off is overdone. That's personally what I did. I have 200 shares of XLE, which I sold some puts last week, and I got a sign. So 200 shares of XLE at, I think, average price of $73. So I'm down on them right now, and you know, talking about skin in the game, I believe the sell-off in the energy sector is overdue. It's a little overdone. It might go even further, but that's where I'm kind of confident starting building positions. But that's me again, same logic as you. I think there's still a lot of the structural issues there. But again, that's a trade I'm down on right now. But you know, only 200 shares, so not a massive position, and I'm selling some covered calls against it. Over the weekend, Jeff Bezos had also a back and forth with President Biden. Do we want to, without getting political, do we want to slightly talk about this, Andrew, or do you want to skip it?
100%, no, definitely. So the president tweeted that the gas stations, directly he addressed the gas station owners that dropped your prices. And Jeff Bezos quickly, quote and retweeted that, and he said, ouch. I mean, inflation is not something that you want to, handle it like that.
Yeah.
It's either complete misdirection, that instead of taking responsibility for that, say, oh, there's these guys increasing the price, or you just don't understand the basics of how the market works, that supply and demand and the pricing for the profit margins of the companies. But regardless, I was actually surprised. By such a tweet from
Jeff
the president.
Bezos?
And I wonder, not
Bezos
Jeff Bezos, from the president.
president.
And I wonder even if one single gas station owners reduces the price just because the president asked them to do. And the president also mentioned something, that this is the time of the war and the global period. But we have to say that the Russian was only responsible of 3% of the energy of the US. So they're essentially nothing. The sanctions on the Russia, that it has nothing. The U.S. is, not in need of Russian oil and energy. I think one of the reasons that the cost has gone up because the administration has stopped some of the public land oil extractions leases, and they were not really big fan of energy from the fossil fuels, which majority of energy is that. And now in the time of this instability, when they don't have enough capacity or at the very good cost to produce the energy that requires for that. And that, this sustainability issue and energy security has actually impacted a lot of energy companies, the clean tech energy companies as well. Because, you can talk about moving and switching to a more sustainable and clean energy when you do not have the energy security concern.
Yeah.
But now this war and all of this inflation situation shows that between people having a clean energy for the next 100 years, or the gas that they have to pay at the tank, people can start becoming a little bit impatient. And that's a tough situation to be for politicians.
Yeah, definitely. I mean, for those of you who are interested to learn more about this, there's a really good podcast called Odd Lots. And one of the guests they had was a commodity trader at Goldman for over 10 years. His specialty was oil and gas and energy. And one of the things people forget is when we talk about crude oil going up, that has nothing to do with gas station, right? That comes in the refinery process, right? So there's lots of upstream element that goes into it before crude turns into, your gas at a gas tank. And a lot of this has been, I've talked about it in my article, you know, the ESG, the environmental lack of investment, lack of capex into the refinery capacities, right? And there was that ratio that I showed a couple of weeks ago that was it's called the crack spread, which basically shows how much premium people are charging for the refined oil from the crude. And that crack spread is actually at all-time high right now. And this is one of the reasons that is leading into higher gas prices. So, you know, lack of capacity in refineries, not necessarily the increase in the price of crude. So again, it's a really great podcast if you want to learn a little bit more about it.
How long is the podcast, Adi?
It's like 50 minutes each podcast. But if you're a avid podcast listener, you know you got to put it at 2x the speed, right? And your brain gets used to it, and you consume everything a lot faster because there's so much good stuff out there. You can't listen to everything 1x. But that's a really good one. Maybe I can put the link on.
And how frequent they're publishing it?
They do, I think, one a week on different topics, but hot topics. So, you know, oil and gas, of course, was really hot. So they did multiple sessions on it, and they were really eye-opening. And you see how, you know, these kind of lack of investment. Like, you know, energy, Andrew, is only 5% of S&P 500, and it's crazy to think about how energy being such a big conglomerate and such a huge part of our life, and how much it actually contributes in terms of earnings to S&P, only being 5% of S&P, meaning that shows the lack of investment, right? The money is not flowing into energy. And when the money is not flowing, a company can do capex, capital expenditure. When they can do capital expenditure, they can expand their refinery capacities. And these are, by the way, huge supply chain commitment. It's not just, oh, let's just open up the click a little bit more and make a little bit more. So these are like 5-year, 10-year plans. So anyway, great stuff. And of course, the station owners, their margins are also really limited. It's not like they're charging like a lot of stuff and they're rolling in the. Somebody tweeted something really interesting. He said the intern who used the president Twitter to tweet that needs to get fired. And I tend to agree.
Yeah, that's definitely. I doubt that the president himself would tweet something like that. But overall, maybe it shows you know, a mindset in the administrations that you know, blame it on them, and that's definitely not something. And it's really funny there when someone comments on your tweet, and the comment gets more like that the original tweet.
You get ratioed.
They call it you have been ratioed. It means that you know. And there was a guy. His name is Greg. He's a really nice troller. And he actually went and he commented, and I think he ratioed president in the number of the likes.
Yeah, I think he was trying it.
He was trying it. President, all of my local gas stations, they dropped their gallon for $2.
Yeah, immediately.
And, because they had the notifications on. And this is obviously a joke or sarcasm. Let me see if I bring the president. And then it's very funny that some local reporters reach out to him and say, which one? We want to record a story on that. Even a lot of people did not get that this is a joke and this is just a sarcasm.
Yeah, the guy worked for like you know, like a local Fox station. So like, you know, it wasn't like he was a real reporter. Like he's like, oh, we want to do a story on that.
Yeah. So here you can see my screen actually. If we show my screen, so this guy Greg is a really funny guy. He's really funny guy. So he posted that, you know, yes, all of my local gas stations dropped, and he got 156,000 likes, and the president tweet itself get 171,000 likes. So that's you know, it was very close. I think at a certain stage he was ratioed. You know, the number of the like was more than that. But essentially, this is just a sarcasm. You know, that tweet doesn't do anything.
Yeah. Yeah, Bill is saying something really interesting as well. He's saying station owners often sell gas at a cent or to profit. That's exactly right, Bill. Their margins are not amazing. Hence there is that convenience store inside, so they can sell other things for markup. That's another thing that, you know, obviously was kind of misled in that tweet. But that's about it. I mean, we covered a lot. Oh, Bill Ackman was also. I think his fund is having a really rough time. I can't wait for the half-a-year performance I think his fund is really having a really rough time, and he's been very critical of the Fed, and he took on Twitter again and kind of talked about how the rates needs to continue to move higher so we bring the inflation down, and kind of laid a case for high quality growth companies, and those are the businesses that he invests in. And he had a few back and forth as well. But he's basically saying growth and pricing power look cheap, right around here.
Yeah, so I think they say it's not the bottom until Bill Ackman cries on CNBC. So that's the word on the street right now. Because Bill Ackman, I think during the pandemic, he went into CNBC and cried because of he had a big short in the market.
Yeah, you know, Andrew, this is very interesting in terms of how you said it's not a bottom till Bill Ackman cries. Is look at the volatility. This is VIX, and look at the market. This is one of the first few bear markets that the market is going down, but the VIX hasn't really spiked up.
It's just because it's a grinding market.
Yeah.
This is for the last 6 months. Market is just slowly going down and grinding you with low volume, and it just drives you crazy. In the pandemic, we bottom in a matter of 2 weeks, and we know exactly where we're standing. But this one is just constantly going down. And this is another thing, Adi, that you mentioned, that a lot of people look at the S&P 500 and say, okay, all-time high was January 4th, and then the 6 months of. But S&P 500 is only 500 companies, over 9,000 publicly listed companies, and the downturn started from June last year. So since the summer of last year, we have such a huge data. So for example, I had PayPal just by any chance. Let's take a look at the PayPal. The top on the PayPal was, not actually the December. December PayPal was already down 50% from its all-time high. The down was in June and August. So a lot of these companies that you were seeing here they're down. Actually, that's exactly it started right around the June last summer. The downturn has started. So you see the capital market is not really doing well. Yeah. Not only for 6 months, it's actually in the last. Every ticker, you just name it.
Roku, I think it will be identical to this.
Roku, a lot of these companies that you see again back in June, July. Let's go there. Let's go to something like Beyond Meat. I mean, not even non-technology companies. You can see the up to here around $160 and it's still in downtrend.
Wow.
So the big downtrend movement started, and it's just driving the investors crazy, and the trust in the financial market has gone out, and it's really hard. And it's
my portfolio, Andrew. You can bring that up.
It's same as well. But here's the thing: the stock market is not for making money. It's not a casino. It's a capital market.
Yeah.
And if you do not support the capital market, then it's really hard to innovate. The companies need the funding, the bond market support the corporations.
Yeah.
And if you do not support this market, then that's what the big recession and depression essentially starts. And it's a very, very, very unique bear market. That's why we want to go into Dr. Reed's presentation tonight and see what the 10 things that we should or we should not do.
Yeah, he's amazing. He was a guest of our show. He was the first guest of our show, and we had a lot of trouble actually having him on. But he talked about don't try to make sense of the news in the bear market. And somebody just asked the question in the chat, is like, why did market rally when the Fed's minute came out? And I was reading the Fed's minute, and to be honest with you, I didn't see anything bullish there. Don't try to make sense of it, right? Especially because this Fed's minute was from 3 weeks ago, 4 weeks ago. Like, don't try to find bullish narrative to explain the price action. Look at the price action and just decide based on the price action. I think
the Fed has been very, very clear about what they want to do. They cannot be more clear than this, that they are just there to control the inflation. It means that if they have to bring the Fed's overnight rate up to 2%, they do that. It's very, very clear. Yeah. And what they do next one is just they look at the economic data. The CPI number comes, job numbers are coming. They just look at it and make decisions every month, every meeting as they go. But they are not there to rescue the market. They're not. They have no responsibility to make sure the market is making another all-time high.
Yeah. Speaking of that, by the way, this in a couple of weeks when they meet, right? And if they do another 75, the Fed's fund rate is going to be at 225. 225, man. That's so the IB Interactive Broker, our margins is going to be at like almost 2.5%. Yeah. So money is getting a lot more expensive.
It gets a lot more expensive. Yeah. But it's not. To be honest with you, it's not about the interest rate. I mean, a lot of people say interest rates and the market is dropping. When during the dot-com bubble, the funds rate was at 6%, 5.5%.
Yeah, 5.5%.
And during the 2004 to 2006 bull market in the housing market, the Feds were also aggressively increasing the interest rate. But what happened? So who cares what the Fed's rate is really 0.5 or 1%? The matter is when the confidence goes out of the investment in the financial market, and that's becoming dangerous.
Yeah.
When you take a risk and it works, the next time you take another one and another one. But when the confidence goes out of the market, everyone is running away from that. So it's not that the aggressiveness of the Fed's rate hike is dropping the market. It's just that everyone is just running away because the way that they're doing it, by increasing the pressure on the mortgages and the housing and everything, it makes the financial market, which is essentially for investment, is scary, and everyone is running away from these to the safe havens.
Yeah, definitely. Capital allocation, it becomes a lot harder, right? Like one of the things we were doing was interest rate arbitrage. So we were borrowing really cheaply, putting it in high income, high dividend stocks, getting the dividend, and then eating that spread. Doing something that the hedge funds usually do, right? Interest rate arbitrage, and these arbitrage opportunities are kind of vanishing really fast when the rates start to go up. Again, it's that delta. It's all about that delta, the degree that the change happens. I don't have anything more, Andrew, to talk about. I think it was a great show. We almost ran for an hour. Over 180 people still tuning on with us. If you enjoy the show, give us a thumbs up. Tomorrow we have Jay Singh, who was managed a portfolio of over $2 billion at Goldman Sachs, one of the biggest and the best bulge brackets in the world, right? Investment banks in the world. A lot of experience as an institutional trader, as a capital allocator. He's going to come on the show. We're going to talk about the market, the housing market, the crypto, the rates, what's going to be the best trade over the next 6 months. Everything in that nature. It's going to be an awesome session. Definitely tune in. He just accepted my calendar invite, so I know he's definitely coming for tomorrow's show. So make sure to tune in. I think it's going to be an amazing day. And then the week after, we have Mr. Brian Shannon and so many other amazing guests coming on the show.
Awesome. Thank you so much, guys. So just one thing, guys. To stop the bots and spams from the chat, if you subscribe to our channel, after 1 minute you can actually participate in the chat. Because if you don't do that, there's a lot of these bots are coming with the sexy photos and nudes and stuff, so we have to just delete them. So we put this that if you're new and you're watching us, subscribe to the channel, wait for 1 minute, and then you should be able to participate into the chat. So I don't know about these 165 people that are watching, how many of them are the bots and how many of them are actually real people, but if you give us a thumbs up, we can kind of get a feeling that how many of you bots. So if you're not a bot, please give us a thumbs up, and if you are a member, you should be able to chat and ask your questions. But yeah, so that's one thing that we had to do, because YouTube has this option to stop the spams.
Shout out to Frederick Valdez. He said, "Thanks a lot, Bubbly." Yes, Bubbly is a good stuff. Thanks a lot, man. Thank you. Thanks everyone for tuning in. Don't forget tomorrow's show. Put the notification. Again, a really amazing opportunity with Jay coming on the show. A trader at Goldman Sachs. Can't get any better than that, right? So definitely excited for tomorrow's show. If there's any specific questions you want me to ask him or Andrew to ask him, send us an email at rd@bearbulltraders.com because I have to send a list of questions to him tonight. So he knows what to kind of expect. So let me know if there's any specific questions. Thanks, everyone.
Thank you, everyone. Awesome. I appreciate the support, and see you tomorrow in the chat. If not, tonight in the webinar room, guys, for Dr. Reed. Bye.
Dr. Reed, definitely. I'm going to tune in.